Welcome back to Market Survival School. Here is the market update without the noise. The index is not broken. The S&P 500 is sitting near its 52-week high, roughly 2% below the high, and still above both the 50-day and the 200-day moving averages. That means the broad market trend is still constructive. But under the surface, the leadership changed. QQQ is still above trend, but it pulled back more than the S&P over the last month. Technology had a monster 3-month run, but it cooled off. At the same time, financials, healthcare, industrials, and small caps have started to show better action. That is rotation, not panic. Volatility is also not screaming danger. The VIX is near 16, below its 50-day and 200-day averages. That tells you traders are not paying panic prices for protection. Calm volatility does not mean no risk. It means the market is not pricing a crash right now. The bond market is the caution flag. TLT is still below its 200-day average, while the 10-year yield is around the mid-4% area. In plain English, rates are still high enough to punish overvalued growth stocks. If a company is expensive and earnings are only okay, the market can punish it fast. So the survival school read is simple. Stay invested only where the setup is clean. Do not chase vertical moves. Do not buy low-quality garbage just because it is cheap. Look for 3 things: real cash flow, a valuation reset, and a catalyst that can change the story. That brings me to the stock I am watching, Upwork, ticker UPWK. Upwork is not a perfect company. Revenue growth is weak. The freelance marketplace is under pressure. And AI is both a threat and a possible tailwind. That is exactly why the stock is down hard. It is still roughly 58% below its 52-week high. But here is why it is compelling. The valuation is no longer priced like a hype stock. Enterprise value to sales is around 1.2 times. Enterprise value to EBITDA is around 6.6 times. Free cash flow yield is around 15%. The company has more cash than debt, and gross margins are high, around 77%. That combination matters. A beaten down stock with no cash flow is a gamble. A beaten down stock with real cash flow and net cash is a setup. But this is not a blind buy. The chart is still damaged. UPWK is only slightly above its 50-day average and still far below its 200-day average. That means the first move is not to chase. The trigger is confirmation. Price needs to build above the recent base, hold the 50-day area, and eventually reclaim the 200-day. If it fails back below support and the company cuts guidance again, the thesis is wrong. The bull case is simple. If management stabilizes growth, protects margins, and proves that AI increases demand for skilled freelance work instead of destroying the marketplace, the stock can re-rate from distressed valuation to normal profitable marketplace valuation. The bear case is also simple. If active clients and gross services volume keep weakening, or if AI disintermediates the platform, then cheap gets cheaper. So here is the final call. The market is constructive, but more selective. Rotation is broadening beyond mega-cap tech. Upwork is one of the more compelling risk-reward setups because the valuation reset is real, the cash flow is real, and the market has already punished the stock. But the entry must be disciplined. Market survival rule: do not buy because the stock is down. Buy only when the business survives, the valuation gives you room, and the chart starts confirming the thesis.